Hello there and welcome to Oil Market Insight. We're here in Vienna on the occasion of the 159th OPEC conference, so a very warm welcome to you all, and indeed to my guests. I want to introduce you to Cornelia Meyer. She is the Chief Executive Officer of MRL Corporation, so we're delighted you could join us again. Bill Farron-Price, thank you, Bill, so much, CEO of Petroleum Policy Intelligence.
Thank you.
And here on my right, Jason Schenker. Jason is the President of Prestige Economics. Now, it's been a while since we've actually had an opportunity to talk and to meet. And over those past 6 months, really, so much has happened. And so much, I think, that could possibly never have been anticipated, really, in this market. I want to start with you, Jason. A lot has gone on here, a lot of influences now that are impacting the oil price and the fundamentals, demand and supply, and just the huge picture. So very quickly, bring us up to date with that huge picture in terms of, what are the issues that the ministers have to be looking out for now?
Sure. To paint a really broad brush of what's affecting prices and what OPEC is thinking about, as always, they're thinking about supplies. Is the market well supplied? They're thinking about demand. What's going on in the United States? Is there a soft patch? How does sovereign debt concerns in Europe, as well as the recent downgrade or credit watch with a threat of a future downgrade to the U.S., how does that play into it? And then how do other fundamentals trading factors that are non-fundamental in financial markets play in? How does the dollar impact prices? How has a recent very sharp run-up in prices followed by a mini commodity flash crash, how does all of that translate into implications for their policy, and what does that mean then for prices in the medium and the long term?
And indeed, we tend to hold Jason responsible for the U.S. economy anytime he's here. Sorry to put you on the spot on this one. But no, you have not performed as well as people expected, and perhaps as many people would say they should have. I mean, there's been some time to come back onto the market, and I think, what was the monthly oil market report from OPEC was just giving figures about 1.8% growth in the first quarter of Q1, way below even what it was in the fourth quarter of 2010. So why is it so sluggish?
Well, there are a couple things with the U.S. economy. First and foremost, on a magnitude basis, you're still talking about tremendous growth in absolute terms. In a percentage term, are things a little slower? Yes. My firm, we have been forecasting that GDP growth in the U.S. this year would be closer to 2.5%. The IMF and most of the street has been looking more towards 3%. It's probably going to be a little bit closer to that 2.5% number. So we're not terribly disappointed because we had a more bearish outlook going into the year. I think people were a little bit overly optimistic about what this year would be like economically, but the truth is this year is going to be the strongest year of GDP growth that the U.S. economy's ever seen in real terms. And so that's very strong. The other thing I would say, and what's important for oil, is that gasoline prices are up about a third year over year and have been for the last couple of months. But demand destruction has only been about 2%. So I can't think of too many things out there that go up in prices by a third, and the demand only goes down by 2%. The American economy is very inelastic. There's a lot of demand for gasoline. And the last thing I would say that's really important, and that maybe I would take a slight disagreement with what you two have said about the markets, is that at the end of Q2 here, the reason we've seen a big pullback in prices is because the dollar got a bump. And if you looked at the price of oil, the price of Brent or WTI in euro terms versus dollar terms, the price increase in dollar terms was much, much higher in percentages because the dollar got hit so hard. And now that we've seen not only a correction in the commodity markets for prices, but also the dollar's gotten a bit of a bump, you see that the differences have narrowed somewhat. And I think that the currency issue and what happens with the dollar in the future is going to be really critical for oil prices. And I think it poses significant upside risk because in the medium and longer term, there are massive threats to the dollar, regardless of how the U.S. economy performs. The debt issues in the U.S., the entitlement issues, these are huge. This means a lot for oil. This means a lot for the bottom line. This means a lot for prices that the world will pay for crude.
What happens, Jason, when quantitative easing is no longer there as the sort of the crutch, so to speak?
Probably not much, because the truth is that the Fed, unlike other central banks, most central banks have a single mandate, and that's to contain inflation. The Fed has two mandates: contain inflation and have always a maximum employment and maximum growth that you can get while keeping inflation stable, prices stable. So, given the fact that U.S. unemployment is over 9%, and U.S. GDP growth, the most recent quarter, is 1.8%, the Fed's not going to be raising rates anytime soon. And even when they do, it will be very, very slowly. The end of this year at the earliest, and even then it's likely to be 25 basis points at a time. Other central banks, the ECB and other banks, are already moving rates higher. They're being more vigilant against inflation. This just means in the U.S. you're going to have more inflation. You're going to have further depreciation of the dollar, and that means, again, potentially higher oil prices. For OPEC, which I always view as the central bank of oil, they're looking at the same factors that every other central bank is looking at. These growth dynamics, the demand dynamics, the global recovery, and the truth is what they're trying to do is keep the market well supplied. There are no shortages, there are no problems in terms of meeting the global demand. It's being met, and for now, that's the situation. But they're going to monitor both the upside for demand as well as the downside for sovereign debt risk in the medium term, for sure. You know, and that's a great point, that 2011 is sort of like 2008, because at the beginning of the year here, we've had this big run-up in commodity prices across the board. Now we've had this kind of mini crash down. But the fundamental difference is 2008 is also like 2004, which was really the beginning, or just at the beginning end of the last business cycle. And that means we have many more years of economic growth before we see another major cyclical downturn. And if that's the case, this is fundamental growth globally, coming from not only the main powerhouses and marginal sectors, or additional marginal demand from the Middle East and elsewhere. You're looking at marginal demand being pushed up really across the board, because this is a cyclical play. Oil is looked at not only as a dollar hedge, but it's an inflation hedge, and it's a global macro play. And even though prices have suffered a very big recent drop, the truth is institutional investors, as well as individuals and endowments that have entered this space to invest, that are making a long-term bet, there is a limited supply of oil on the planet. There is a demographic trend of growing growth, growing demand, and you have a secular pricing mechanism of the dollar potentially looking lower. All of those things make this really an ideal asset class that it was beginning to look like in 2008, but now even more solidified. A lot of things that are really bullish on trend for crude.
But surely this is a good message to the market as well, and indeed one of OPEC's very strong sort of tenets, the very foundation, that they will continue to invest, and they've always said time and time again. So when they're faced with the dilemmas that are on the table right now, and there's probably maybe some of them they wish that were not there, but they've all come together. I mean, this is tough, but ultimately, they're going to continue that investment, and they're going to take care of, their customers. If that demand goes away, there's no point. There's nothing you can do.
Demand's not going to erode in a significant fashion. Even right now, if you look at alternative energy, you're hoping to mitigate future marginal demand increases. Demand's not going to fall off. And even if there are additional supplies, if we think about deep water, we think about shale, the cost of turning this into a usable crude, bringing it to market, it's very, very high. You're at the end of the cost curve at that point. And so I completely agree with Bill. There is oil that would be cheaper to bring to market, but there are structural things that make it more complicated. And I think there's rising domestic demand in all the OPEC member countries as well. Not too long ago, Indonesia was a member and now is no longer an exporter, is now an importer.
This is a good point.
And only last month, I know Germany came out with their statement that they're going to cut back on nuclear power plants, and so that again, will have a general impact. But again, the power sector is very much dependent on coal and gas, but the transportation, for the most part, is that where the big drive will be? And again, air transportation is constantly on the increase.
Absolutely. It's transportation. Oil is for transportation. The power sector is really, we are talking nuclear, gas, coal, renewables. That's a different game.
Now, you want to come in on this one?
No, it's funny because before we sat down formally, Bill and I had actually had this discussion about jet fuel. And what most people don't realize is, in terms of transport, jet fuel, there's no substitute. But not only that, most people don't realize that the blending value of jet fuel is very high. You can turn bunker fuel resid, you can blend it up using jet fuel into distillates, you can blend distillates into effectively diesel, and from diesel you can blend actually into gasoline if you blend the right way and use jet fuel. This means that jet fuel is very, very, very valuable in those barrels. And in the medium and long term, something that I always tell people is enjoy flying while you can. Because it's not going to be cheap forever. It's going to get very, very, very expensive. The global demand for distillates is rising, and jet fuel is the most valuable molecule. And if you have a choice to make a marginal decision to fly or to have more diesel to transport trucks in long hauls, there's going to be a greater economic multiplier, most likely from freight shipments rather than from jet fuel. So enjoy flying while you can. It will get very, very expensive someday.
And I suppose we do take it for granted that we're expecting flight costs to come back down again and constantly to be cheaper for everyone, but maybe we're not taking into account exactly that sort of the limit there is on oil production.
I see no sign of airlines abandoning the fuel surcharges that have been in place for years now. In fact, they've almost been institutionalized in the price. I think it's you will see still the low-cost airlines will continue to flourish, but that's more to do with the model, the business model that they adopt, which is a cost-cutting model compared to the established flag carriers.
And to make matters worse, we have all these emission targets that will make it, and these new emission taxes that will come on airlines. It's an impossible investment model to run an airline.
Well, looking at just the pressures we're looking at on the economy and indeed on such things like transport, I want to wrap this up really and come back to the three of you and sort of take the helicopter view of the situation where we are at the moment. I know you talk, and I think it's I like that the central the central bank of oil. Yep. This is what you're affectionately calling OPEC right now. But where do you see that playing?
You know, I think it's very interesting that in this business cycle, with prices as high as they are, OPEC is meeting far less frequently than it did the last time we saw these prices. And to me, that's very significant on a couple levels. But first of all, if OPEC met every time the price went up $10 or $20 a barrel, they might as well just be here all the time because the markets have become very volatile. And the second thing is that they're meeting now with a frequency, and they're sending messages to the market that the market's well supplied. They're watching demand. They're very carefully watching these financial market factors. But I think it's very important that right now I think they see things in a stable growth trend despite the upside and downside risks. And this is why they're able to meet somewhat less frequently. And I think they're sending the right signals and being careful not to send too many signals to the market, which most central banks have gone through this at different points in time where they sent too many signals to the market or not enough, and striking that balance is something that I think OPEC's working towards now.
The central bank of oil, what do you think of that? So once again, challenges, more challenges and more challenges, but hopefully everything is in place to actually meet those challenges. This has been the Oil Market Insight on this occasion here in Vienna, and we really thank you all for being with us. Now I want to thank Jason for joining us too, Bill, and indeed Cornelia, as always. Just a delight to see you all, and thanks so much. And we'll be back with you the next meeting.